You wake up in a world that feels unpredictable. Markets rise and fall overnight. Currencies collapse without warning. And entire nations plunge into crisis even when everything seemed stable the day before. But what if I told you something disturbing? What if every crisis you see, every financial meltdown, every sudden shortage isn't just an accident of the global economy, but the outcome of a hidden playbook, a silent strategy used by the people who profit most when the rest of the world is panicking? This video pulls the curtain back, not on rumors, but on a pattern that has repeated for over a century quietly, ruthlessly, and with billions on the line. A pattern that reveals one uncomfortable truth: they depend on them. For most people, a crisis means lost savings, lost jobs, lost security. But for a small group, banks, speculators, and financial institutions with global reach, crisis is something else entirely. It's a window, a moment where rules bend, governments beg, and markets are vulnerable. This idea isn't new. It traces back to the late 1800s, when banking families and early central institutions realized something profound. Money wasn't just a tool, and the moment an economy shakes when fear replaces confidence, that leverage multiplies. But let's rewind to understand how this playbook was born. The origins can be traced to a simple but powerful discovery. When markets panic, people rush to liquidate assets, sell currency, borrow money, or accept terms they would never accept in normal times. This created an opportunity if you controlled the money supply, credit lines, or emergency liquidity. You could effectively dictate the rules during chaos. The early 20th century is full of examples. During the panic of 1907, the US banking system nearly collapsed. Banks fell, industries froze, and chaos spread. But while ordinary citizens panicked, one man, J.P. Morgan, stepped in as a savior. He financed buyouts of weakened competitors. He absorbed assets at fractions of their value. By the time the panic ended, Morgan emerged stronger than ever. A crisis destroyed trust. Decades later, the creation of the Federal Reserve added a new layer. Now, the ability to stabilize markets wasn't in the hands of a single banker, it was institutional. And with it came a new pattern. The more countries borrowed, the more they depended on the very institutions that profited when those debts became unsustainable. This was the rise. Through the mid-20th century, wars, recessions, currency collapses, oil shocks, inflation waves, something strange kept happening. Whenever the world fell apart, certain financial players grew richer. Why? Because crises forced governments to borrow more, print more, and sell assets faster. And every time nations borrowed, they handed over a little more control to lenders, banks, and organizations like the IMF. And then came the breaking point, the late 20th century, when finance stopped merely reacting to crises and began to exploit them. The 1997 Asian financial crisis wasn't just a regional collapse, it was a global takeover. Currencies were attacked, markets destabilized, and nations were forced to accept bailouts that reshaped their economic policies for decades. Entire countries were told who to tax, what to cut, and how to operate by the same institutions providing the loans. The 2008 financial crisis was even bigger. But what happened to the institutions that caused the crisis? They were rescued by the very governments they had pushed into risk. And afterward, they bought foreclosed assets, weakened banks, and distressed companies for pennies on the dollar. Crisis wasn't a failure, a moment where the powerful picked up the pieces and built an even bigger empire. This was the fallout. You'd think the world learned its lesson, but the same playbook continues only now. It's global, digitized, and faster than ever. Look at the patterns. When inflation rises, the poor lose purchasing power, but central banks tighten policy, strengthening currencies and increasing demand for government debt. When countries default, global lenders step in with rescue packages that carry interest, conditions, and long-term influence. When markets crash, hedge funds buy assets at historic lows and sell them after the panic for massive gains. When currencies weaken, speculators make billions betting against national stability. And when a crisis forces governments to borrow, the more you look, the more disturbing it becomes. Crises don't break the system. Let's examine one recent example. When the world shut down in 2020, stock markets crashed violently. Within weeks, trillions of new currency units were injected into the economy. And while ordinary citizens struggled to survive, the wealthiest institutions saw one of the largest profit surges in modern history. Tech stocks surged. Private equity firms bought distressed businesses at record discounts. A global crisis created the greatest wealth transfer in decades. The playbook didn't just survive, but what is this playbook, really? It's a repeating sequencer pattern of behavior that quietly rewards those who control money flow during times of panic. It looks like this. Step 2. Step in as a rescuer, offering liquidity, loans, or buyouts. Step 3. Attach conditions, acquire assets, or profit from market swings. Step 4. Strengthen your position so that next time the crisis pays even more. It's a cycle built on fear, leverage, and timing. Most people will never see it because crises feel random when you're inside them. But from above, where global financial power sits, there predictable, manageable, and profitable. Which leads us to today, a world drowning in over $300 trillion in global debt, with every major currency slowly losing purchasing power. A world where central banks hold more influence than elected governments. A world where wealth gaps grow with every economic shock. A world where the next crisis, whatever it looks like, may already be written into the next chapter of this silent playbook. Now, before we end, here are 3 takeaways every viewer must understand. First, crises don't redistribute wealth randomly. They funnel it upward to those positioned to lend, buy, or control during panic. Second, every national financial collapse strengthens the institutions that provide rescue money, giving them influence over policy, resources, and long-term strategy. Third, the system isn't broken, it's functioning exactly as designed, rewarding those who treat crises not as disasters, but as opportunities. And here's the warning. As global debt grows, currencies weaken, and geopolitical tensions rise, the next crisis may not be a simple market crash. It might be structural, and the same playbook will activate only with bigger stakes and deeper consequences. If you want more videos that break down the hidden mechanics behind global finance, economic manipulation, and the systems shaping your future, make sure to like this video, subscribe, and turn on notifications. There's more to uncover, because once you learn how the playbook works,